Hey everybody, welcome to Chapter 10 Practice Test. This is one that I pulled off of, the little link on the study guide. They have the self-test and I think the additional self-tests are called. This is the self-test. So I'm just going to narrate my way through it. Hopefully it's useful to you as I do so. Also, just by word of warning, I have no way of checking these answers, so it's possible I could make a mistake as I'm going through. So if I do that, I won't know until I submit the quiz at the end, the same way you would. So you may want to double check the end of this recording just to make sure I got everything right. I don't want to be confusing you. You'll try to follow what I'm doing. If I made an error or something, I won't know till the end. So just kind of a word of warning on that. I don't intend to make any errors, but that happens. Anyway, so here we go, Chapter 10. So which of the following is a criterion for the classification of a liability as current? It's a debt that can be paid from existing current assets. That is true. There's a debt that can be paid through the creation of other current liabilities. That is also true. And it must be paid within 1 year or the operating cycle, whichever is shorter. Now that is a little bit tricky. So let's make sure we read them carefully, and because I think that it should be whichever is longer. I think this is a dirty question. So it is true that if it can be paid from existing assets or the creation of liabilities, those are both true. But this third one, it must be paid within 1 year or the operating cycle, whichever is shorter. That one's false. It should be whichever is longer. So we're going to choose 1 and 2. All right, which of the following is not a current liability? Interest payable, that is. Mortgage payable, nope, that's long-term. Salaries payable, short-term or current, and current maturities of long-term debt is current. So that one's good. Which of the following is not a typical current liability? Prepaid rent, that is an asset. Taxes payable, that's a liability. Unearned revenue, that's a liability. Current maturities, long-term debt, that's a current liability. So it's prepaid rent, that's an asset. Number 4, corporation issued a $50,000 9% 4-month note on July 1st. The corporation's year end is September 30th. Which of the following is the adjusting entry for interest on September 30th? So step 1, let's figure out our time period involved here. If it's issued on July 1st, we're talking about all of the interest for July, all the interest for August, and all the interest for September. So 3 months worth of interest. So this is a simple principal times rate times time. That's how we figure out our interest. So our principal in this case is $50,000. Our rate is 9%. And our time is going to be, 3 months, right? 3/12. So our interest will equal the principal times the rate times the time, or 11.25. I'll go ahead and set this up since we're going to use it a few more times, it looks like. So on time, all I did is I expressed it as a fraction. It was 3 months out of 12, right? Because if we multiply the principal times the rate, that's going to give us the amount of interest for 1 year. And then the time is a fraction of a year, 3/12 or 0.25. All right, so that is 11.25. And then the nature of the adjusting entry is that it would be an interest expense. That would be our debit. And it should be an interest payable will be our credit. So interest expense, 11.25, and interest payable, 11.25. All right. Number 5, on September 1st, the Banner Company, you might know its subsidiary, the Hulk Corporation. I know that was lame, but that's all I got. Anyway, So the Banner Company borrowed $70,000 from Citibank for 5 months at 9%. Which journal entry will Banner Company make on December 31st before issuing its financial statements? So again, we have to figure out our time frame here. So we have our principal, 70,000, our rate, 9%, and our time, if it was borrowed on September 1st, we have all of September, October, November, and December. So in this case, we have 4 months, so our time will equal 4 divided by 12, or 4/12. And our interest will be our principal times our rate times our time, or $2,100. I think, let's see. Well, it didn't like that. 70,000, principal, rate, 9%, time. Oh, it's right there. I just missed the 2,100. So it's an interest expense and an interest payable. There we go. Number 6, unearned revenue is a type of current liability. Why, yes, it is. That's true. Remember, unearned revenue would be revenue that you've received but have not yet earned, usually in the form of prepayments from a customer. Somebody pays you ahead of time for something, but you haven't earned it. It's a liability until you earn it. This happens a lot in my business with storage sheds. People pay for a whole year. I go ahead and write down the total amount that they've paid me as an unearned revenue. And my cash goes up, so it's a debit to cash and a credit to unearned revenue. And then each month I charge 1 month's worth of rent, and I've now earned it. So I debit the unearned revenue, or decrease the liability, and credit the revenue account. And that's how we deal with it. So in this case, that's what unearned revenue is. All right, let's look at number 7. Cash register tape indicates that cash sales are $2,000 and sales taxes are $155. What journal entry is needed to record this information? Well, so we know that we collected both the sales and the sales tax. So our cash will go up by $21.55, a debit to cash of $21.55. So that eliminates B and C. And we also know we have to account for the sales, which is a revenue account of $2,000, and the taxes payable of $155. So the answer is D. All right. The Jacksonville Jaguars sell season tickets to NFL football games. There are 10 home games during the season, which run from August through December. During February, 65,000 season tickets were sold. That'd be great if they could really sell 65,000 season tickets. That's most of their stadium. Anyway, 65,000 season tickets are sold for $12 million cash, which account will be credited by the Jacksonville Jaguars upon receipt of the $12 million. So again, season tickets are an instance where they're receiving cash before they've earned it, right? They don't earn it till the people actually attend the games. So they're going to debit their cash account and they're going to credit their unearned revenue account. In this case, I guess they call it unearned ticket revenue. Number 9, on December 30th, 2012, a company issues a note payable of $50,000, of which $10,000 will be repaid each year. What is the proper classification of this note on December 31st, 2012? So upon issuance, we recognize that of the $50,000, $10,000 of it will be paid this year, meaning $10,000 of it's a current liability, and the other $40,000 is a long-term liability. So that's A. 10. At what point and how are sales taxes charged to customers? Sales taxes charged to customers recorded. So if we charge to customers for sales tax, we do that immediately at the time of sale. And remember, we're doing two things. We're having a sales revenue for the amount of the sale, plus we're having a liability for the sales tax. As soon as we collect it, we owe it to the state. So this will be collected at the time of sale as a liability, never a revenue. 11, a corporation has $1 million, 8% 5-year bonds. The 8% rate of interest is called the blank rate. So this is, if you look at a picture of a bond, this will be the rate that's printed right on the face of the bond. Sometimes it's called the face rate, other times it's called the contractual rate. Okay, the market rate or the effective rate, those are synonymous terms. Those have nothing to do with what's printed on the bond. Those have to do with what's going on in the bond market, the interest rate market. So this is contract rate or contractual rate. 12, to what is the current market value of a bond equal? Okay, so a bond, to find its current market value, what we have to do is we have to find the present value of all of the cash flows relating to the bond. And the cash flows of the bond are going to be that it's going to pay us interest for the remainder of its useful life, or the remainder of its till it's mature. And then at its maturity date, it's going to pay us cash equal to the face amount. So to figure out the current market value of the bond, we need to take the present value of the interest rate, the interest payments over its life, plus the present value of the principal or face value of the bond repayment at the end of the bond's life. So does it give us that option? Present value of the principal and the present value of the interest payments. There it is, B. All right, the market price of a bond is equal to the present value of the bond's principal. False. It's the present value of the bond's principal plus the present value of the bond's interest payments, interest cash flows. Number 14, how is the market value of a bond issuance determined? Same thing, by adding the present value of the principal amount to the present value of the interest payments. They really want us to understand that one. All right, number 15. If the contractual rate of interest is lower than the market rate of interest, bonds will sell at a premium, true or false. So the contract rate is the rate on the face of the bond. If that is lower than the market rate, what that means is that that means that a person investing in a bond, a new bond that's been issued at the market rate, they could get a higher rate of interest, which means they don't want to invest in our little bond that's paying 5% if they could get 6% at the market, which means in order for us to sell our bonds, we're going to have to lower the price. So when the market rate goes up, the price of the bond goes down. So selling that bond would be at a discount, not a premium. So this is false. All right, number 16, Tanner Inc. issued a 10% 5-year $100,000 bond when the market rate of interest was 12%. At what value did the bond sell? So again, here we're issuing a 10% bond when the market is paying 12%. If the market's paying better interest than what our bond is, we're not going to get full price for our bond. So we're going to have to sell this bond at a discount because it is paying a rate that is less than the market rate of interest. Number 17, Hanlon Enterprises issued 2,000 bonds with a face value of $1,000 each at 97. What is the entry to record the issuance? Okay, so the total face value of those bonds is going to be 2,000 bonds times $1,000 each, or $2 million. So our bond payable, we know, is going to be $2 million. We also know that we're not getting that full amount as cash because we issued it at 97. So here, the face value is $2 million. We're going to say that the cash we received is equal to $2 million times 0.97, or 1,940,000. So the difference is going to have to come right here on the debit side. Sorry, this is still set from our last problems, wasn't it? And that's what's going to make it balance, right? Now we have 2 million on each side, on the debit and credit side. So the way I always do this is I just remember if it falls on the debit side, it's going to be a discount. I can also just use common sense and say, look, if this thing issued at 97, that's a discount. And so, I'll do a discount. But you can also do it by figuring out how much the bond is, which is the face value times the number of bonds issued, $2 million. How much cash you're receiving, which is the face value times the price, in this case 0.97 or 97% of face value. And then the difference between the two will be the amount of our discount or our premium, as the case may be. So it looks like cash, discounts, bonds payable, so that's D. All right, number 18. Sosa Corporation issued a 10-year bond with a face value of $400,000 and a contractual rate of interest of 6%. What is the total cost of borrowing for the Sosa Corporation? Okay, so the cost of borrowing is going to include any interest they have to pay. So let's figure out the interest. The interest is going to be the principal times the rate times the time, right, which we've learned. So in this case, the principal is $400,000 times the rate, which is 6%, times the time, which is 10 years. So over its whole life, the bond is going to cost them $240,000 in interest. Then the other cost of borrowing that money is going to be any discount. Because in essence, what's going to happen is the discount, they're going to get 99% of that $400,000, but they're going to have to pay back 100% of that $400,000. So we're going to say that this equals the face value, $400,000, minus the face value times the discount. I'm sorry, times the price. So that comes out to $4,000. That's the amount of the discount that's going to be amortized over the life of the bond. So the total cost is the sum of those two, which is $244,000. All right, number 19. What is the nature of a bond premium? So it says it reduces the cost of borrowing, increases the cost of borrowing, or it doesn't change the cost of borrowing. So here we see that a bond discount increased the cost of borrowing over the interest, right? And that's because, again, we only got 99% of the cash up front, but we had to pay back the full face value at the end. So a discount has the effect of increasing the total cost of borrowing. So that means a premium would do the opposite. The premium has the effect of decreasing the total cost of borrowing, because with a premium, we're getting more than the face value of the bond when we issue it, but then when it comes mature, we only have to pay back the face value, so that reduces our total cost of borrowing. So the nature of a bond premium is it reduces the cost of borrowing. Number 20, Kant Corporation. I don't know if that's named after Immanuel Kant or not. If those of you who don't know him, he's a German philosopher who believed in something called utilitarianism. Check it out. It's pretty interesting stuff. Anyway, so it retires a $100,000 face value bond at 105 on January 1st. Following the payment of interest, the carrying value of the bond at the redemption date is $103,745. Which of the following is part of the entry to record the bond redemption? All right, well, let's just create the entry, and that will do it for us. So if let's see what all is happening here. First of all, if my bond payable had a face value of 100,000, that would mean it's being carried on my books at 100,000, so I'd have to do a debit to the bond payable of $100,000. If it had a carrying value of $103,745, that would mean that it also had a premium of $3,745, an unamortized premium. Then I'm going to skip a line here. I shouldn't have actually indented that. It's still a debit. Maybe it just really wants to be indented. Apparently it does. All right, I'm going to skip a line, and I'm going to figure out how much cash I had to pay out. So if it was a $100,000 face value, and I paid it off or retired it at 105, then I had to pay $105,000 to retire it. So now I've got some difference here, right? I've got $103,745 on my debit side. I've got $105,000 on my credit side. So the difference will have to be a debit, because I'm going to have to make this thing add up to $105,000. So what will this be? It'll be a loss. I'm not sure what they'll call it. Oh, they're calling it a loss on redemption. Sounds good to me. Loss on bond redemption. How can I tell it's a loss? Well, for one thing, it falls on the debit side, which is going to make it an expense, as opposed to a gain, which would fall on the credit side, which would make it a revenue. But the other way I can figure out it's a loss is I can say, look, my carrying value, my bond plus its premium, is less than the amount of cash I had to pay. So it was a loss. I had to pay out more cash than what the bond was worth. And that looks like it will be, well, I'm no good at math in my head, so I'm going to say that's $105,000 minus $100,000 minus $37.45. $12.55 is the amount of my loss on bond redemption. Credit. No. Let's see. Cat Corporation retires the carrying value of the bonds at redemption. Which of the following is part of the entry? So will there be a credit to $30.74 for loss? No. A debit to $37.45 to premium of bonds payable? Yes. So that's the one. I thought they were making us find the loss, but it could be a credit to the $12.55 gain, but there wasn't a gain, it was a loss, and a debit of $5,000 to the premium. That's not true either, so it's B. 21, bonds payable with a face value of $200,000 and a carrying value of $196,000 are redeemed prior to maturity at 102. Which of the following will result? Okay, so let's do the same thing here. So the bonds payable with a face value of $200,000, carrying value of $196,000. So the bond payable is going to be debited by $200,000. In this case, I'm not sure what's going to happen here, but I do know, whoops, I do know what's going to happen here. So these bonds, because they're lower in value than the total bond, this will be a discount on bond payable of $4,000. Remember, carrying value is just the difference between the bond's face value and its discount. Okay? All right. And it's retired at 102, so that means I'm paying out cash of $200,000 times 1.02. Whoops. Got to tell Excel that's an equal. So now I know this adds up to $244,000, and I'm going to have to put in $44,000 over here to make it all work out. Something doesn't seem right. That should be $4,000. And that should be $8,000. Now does it add up? $208,000 on that side, $208,000. There we go. All right, so again, what are we looking for? A loss on the redemption of $4,000? Nope, we had a loss of $8,000. A gain on redemption of $4,000? Nope. A loss on redemption of $8,000? Yes, that's what we found. All right, number 22, a $500,000 bond is retired at 97. When the carrying value of the bond is $483,000, which of the following is the effect of recording the retirement? So same thing. So we know the bond is going to have to be debited $500,000. Why? Because the bond is sitting on our books right now as a bond payable with a credit of $500,000. Okay, if it has a carrying value of $483,000, that means there must be a discount there, right? because carrying value is the bond payable less any discount or plus any premium. So that should be 17,000 or 500,000 minus 483,000. That will give us the carrying value of, a discount of 17,000. We also know it was retired at 97. So the amount of cash we had to pay is 500,000 times 0.97 or $485,000. That's the amount of cash we had to pay out. So it's a credit to cash. So now, again, so on the credit side, we've got 502,000. On the debit side, we have 500,000. So the entry needs to come on the debit side, $2,000. And now we should balance 502,000 and 502,000. And so because it's a debit, it's a loss. So our carrying value was less. We had to pay out $2,000. Now I'm getting confused. Let's see. Yeah, we had to pay out 485,000, but the value of the bond was only 483. The difference is the $2,000 loss. So it would be a $2,000 loss. And number 23, in a recent year, Day Corporation, that's confusing, in a recent year, Day Corporation, had a net income of $150,000, interest expense of $30,000, and tax expense of $20,000. What was Day Corporation's times interest earned ratio for the year? All right, so times interest earned is our operating income. Sometimes that's called our EBIT, E-B-I-T, or earnings before interest and tax. We divide that by our interest expense. I'm sorry, we divide our, now I'm getting confused. We divide our, yeah, that's right, by our interest expense. See? I'm a genius. I can always figure these things out. Okay, I don't do this every day. Actually, I don't do this every day. Like, very seldom in my life does someone say, can you tell me the times interest earned ratio on that? I use certain ratios a lot, like the current ratio, but I don't use this one a ton. Anyway, so let's do it. So we have our operating income, and we will find that by taking our net income of 150,000 and subtracting the interest expense of 30,000 and the tax expense of 20,000. And that's, so they have a total of, I guess I could have done that in my head, operating income of $100,000. And then we'll take our interest expense, which was 20,000, and our times interest earned will equal 100,000 divided by, which should be 5. That's not in dollars. That's 5 times. What that means is that our operating income was 5 times our interest. So there we go. Which of the following is not a measure of liquidity? Debt to total assets ratio, working capital, current ratio, or current cash debt coverage. So our debt to total assets is not a measure of liquidity. That's a measure of leverage, or our debt related to our assets. Remember, current ratio is our current assets divided by our current liabilities. Our working capital is our current assets minus our current liabilities. That has to do with how much money we have available to spend, which is liquidity. And then our current cash debt coverage is our ability to pay debt with our cash. Okay, all right. 25. Which is a very common way to present current liabilities on the balance sheet. Notes payable listed first, current maturities of long-term debt are listed first, by order of magnitude or by order of maturity date. And the most common way that I know is by order of maturity date. We'll see what the book has to say on that one. There's one I'm not 100% correct. I'll get right, because books always want a real specific answer. All right, 26. When a bond is sold at a premium, at what value is it reported on the balance sheet? So when a bond is sold at a premium, we record it on our balance sheet at its face value. plus any premium. So that was easy. All right, 27. Brasden Inc. sells bonds with a face value of $1 million and a contract interest rate of 9% for $1,200,000. The bonds will mature in 10 years. Using the straight line method of amortization of the bond's premium, how much interest expense will be recognized in year one? All right. So here's how this works. First of all, we have our interest expense, or just our interest that we're going to pay, right? And that interest is going to be equal to principal, 1 million, times the rate. What is the period here? 1 year, right? Yeah, so it's a year, times the time, which is 1 for 1 year. So they're going to have $90,000 worth of interest. The second thing we have to do is recognize that either our discount or our premium is going to either increase or decrease our expense here. So in this case, we have a premium, right? We sold $1,200,000. I'm sorry, we sold $1 million worth of bonds for $1,200,000, meaning that we're going to amortize or spread the value or that amount of premium over the life of the bond. So if we have a premium, that's going to equal $1,200,000, the amount of cash we received, minus the face value, so it should be $200,000. So our premium to amortize per year is the amount of the premium divided by the life of the bond, which is 10 years. All right. So in the case of a premium, the premium decreases our total cost to borrow, right? It decreases the amount of interest. So our interest expense is going to be the $900,000 in interest we pay less the premium that we're amortizing, $20,000. So we're going to have $70,000 in interest expense during the first year. Ozone Inc. sells bonds with a face value of $1 million and contract interest rate of 9% for $800,000. So this one's got a discount, right? The bonds will mature in 10 years using straight line method, blah, blah, blah. Okay, so the interest on the bond equals $1 million principal times rate times time, which is 1 year. And then we have discount and our total discount. So the total discount on the bond is the $1 million minus the $800,000 sale price, $200,000. Our discount is going to equal the total discount, our discount per year is going to be the total discount divided by the number of years. So that still comes out to $20,000. And now our interest expense is going to equal the interest plus the discount. So think of the logic behind this. If there's a discount, it means we got less money up front than we're going to have to pay back in the end. So it costs us not only the interest that we're paying, but also that additional money that we have to pay back over and above what we received. Conversely, in the case of a premium, we got extra money at the time of issuance. So that extra money, in essence, reduces the total cost or total expense of borrowing the money. We just spread that out over its life through amortization. Okay, so that's why a discount adds to the interest cost, and a premium takes away from or decreases the interest cost. 29. So that was using straight line amortization. They're probably going to ask us to deal with the effective interest rate method as well. Oh, there it is. Look, on January 1st, Forever Ceramics issued $1 million 9% bond for $939,000. The market rate of interest for these bonds is 10%. Interest is payable annually on December 31st. The company uses the effective interest Method for amortizing a bond discount. At the end of the first year, how much should Forever Ceramics report as the unamortized bond discount? All right, so let's figure out, first of all, our total discount. And the total discount is the difference between the face value, $1 million, and the amount of cash we actually received, which is $939. So there's a total discount of $61,000. The next thing we need to do is figure out the amount to amortize. Amortize just means to spread that discount out over the bond's life. So using the effective interest rate, what we have to do is find the bond interest expense, I can't type, and the bond interest paid. The bond interest expense is found by multiplying the carrying value of the bond at the beginning of the period. Remember, the carrying value of the bond is the face value minus any discount, or plus any premium. In this case, there's a discount. So that is going to be $939,000. And we multiply that by the effective interest rate, or the market interest rate, which is 10%. So there's our bond interest expense. Now we figure out how much interest we actually paid, and we do that by taking the bond's face value, $1 million, times the bond's contract rate, or face rate, which is 9%. So you can see we have a difference here between the amount that is an expense and the amount that's paid. And the difference between those two is the amortization amount. Whoops. $93,900 minus $90,000. So the question is, at the end of the first year, how much should Forever Ceramics report as the unamortized bond discount? So at the beginning of the year, it was $61,000. We're going to amortize $3,900. So the new unamortized discount will equal the $61,000 minus the $3,900, or $57,100. Number 30, on January 1st, Anthony Corporation issued $1 million 14% 5-year bonds. I wish I could find a 14% bond out there. I'd buy it right now. 5-year bonds with interest payable on December 31st. The bonds sold for $1,072,096. The market value of the interest for these bonds was 12% on the first interest date using effective. Okay, so this is the same thing. This says how much is the debit entry to bond interest expense. So let's figure out our total discount, or in this case, it's a total premium, isn't it? So this is going to equal, the premium is going to equal the amount it was sold for. It's $1,072,096 minus the face value, $1 million. So the total premium is $72,096. The bond interest expense then is going to be the carrying value of the bond, which is $1,072,096, right? The face value plus the premium, times the effective interest rate, or sometimes it's called the market interest rate, which is 12%. Oh, I didn't do an equal sign in front of that. There we go. The bond interest paid is going to be the million times the face or contract rate of 14%. So now to figure out the amount we amortize, because we have a premium, we subtract the amount of interest expense from the amount paid. The difference is $11,348. So now the question asks us, be careful and read what it says. It says the market rate of interest, okay, on the first interest date, using the effective interest method, how much is the debit entry to bond interest expense? So our bond interest expense should be $128,652. How did I find that? Well, all I did was I multiplied the carrying value of the bonds times the effective rate. That's how it's done when we're doing the effective interest method. All right, 31. Which is the first step in amortizing a bond discount under the effective interest method? Well, you probably notice that each time I figure out the bond interest expense. So actually, you know what? I figure out the total premium, but the book answer, what it wants you to say is to find out the compute the bond's interest expense. Eyes Inc. issues a $1 million 12% 20-year mortgage note on December 31st. The terms provide for semi-annual installment payments of $66,462, which only covers interest and part of the principal. What is the mortgage balance after the first semi-annual payment? Okay, so remember with installment loans, things are a little bit different because now we're paying the payment's the same every time, but a portion of that payment is going to be principal and a portion is going to be interest. So it's a $1 million note. We have to figure out the amount of interest. So the interest, if it's a semi-annual payment, is the principal, $1 million, times the rate, which is 12%, times the time, which is a half, right? 6 over 12, because it's a semi-annual period, which is the same as 0.5. So there's $60,000 in interest. So the total payment is $66,462. Then the amount that's going to be applied toward principal is going to be the total payment minus the interest, or $6,462 is applied toward the principal. So it asks what the mortgage balance will be after the first payment. It'll be, so we'll have our balance on, we'll just call it beginning, which is $1 million, less so our balance at the end of the period, or at the nth of the period. I'm not sure what the nth is. It's different from an ent because those are big tree things. So it'll be the $1 million minus the $64,62, which is $993,538 for A. We're almost there. How does the IFRS define current liabilities? Let's see, as obligations expected to be paid within 12 months, as obligations paid within the past 12 months, as amounts a company reasonably expects to pay within the next year or operating cycle, whichever is longer. That's their correct one, or which is shorter. That's them trying to trick us. All right, 34. What is the meaning of the term contingent liability under IFRS? So a contingent liability is a debt that you may have to pay, that you expect you might have to pay in the relatively near future usually. So let's see, it is an expected loss. No, it's not an expected loss, it's an expected liability. So is an expected liability related to a possible contingency recognized in the financial statements, or it is an expected liability related to possible contingency not recognized in the financial statements. Typically these are not recognized. So let's see what the book answer likes with that one. All right, so now is the part where I click grade the test, and you can judge me for the ones I missed and be like, see, even the teacher can't do it. So let's see how we did. It says I got 91%, so I missed something. So let's take a look at where we messed up. Hey, don't judge me, I still got an A. And see if we can fix the problem. Number 23. In a recent year, Day Corporation had a net income of $150,000, interest expense of $30,000, and tax expense of $20,000. What was Day Corporation's times interest earned ratio for the year? Well, that one I thought was an easy question. So let's figure it out. So first we need our operating income, which is our net income, $150,000. You know what I did? I subtracted the interest expense and the tax expense when I should have added them back in. So if I had a net income of $150,000, then my net income before my tax expense and before my interest expense was $200,000. So that was my error. Interest expense was $30,000. So my times interest earned $200,000 divided by $30,000. Again, it wants to do it in dollars, but we want to see number 6.67. So that was one. Second, which is a very common way to present current liabilities on the balance sheet. Notes payable are listed first. Respectfully disagree. This book likes to put notes payable followed by accounts payable. I was always taught to do accounts payable first, but my bad. So the answer they want is notes payable listed first. And one more. How does IFRS define current liabilities? I put as amounts the company reasonably expects to pay within the next year or the operating cycle, whichever is longer, which I guess is the book answer. IFRS gives a more simplified definition, which is obligations expected to be paid within 12 months. So there you go. Hopefully I didn't screw you up by getting those three wrong, and hopefully my explanations helped remember. This is a long video, so hopefully people will use it piecemeal on the ones they need. Good luck with the test, and thanks for watching.